Exactly what happened is this. Silver blasted through $90, and within hours, the physical market started acting like it was under pressure. A flagship coin release got pushed back, big box buying suddenly looked managed, and the futures exchange signaled rule changes after wild price swings. That's why today's story is not just silver is up. It's what does the system do when silver won't behave? Because here's the key. Physical markets move first, headlines show up later. And if you understand the early signals, you don't need a press release to know something is changing. So in this video, I'm going to connect three developments that look separate but are clearly connected. The delayed 2026 Silver Eagle rollout, the retail purchase limits that keep popping up, and the new approach to margin requirements for precious metals futures. Then I'll explain what these signals usually mean, why the next few weeks could surprise people, and what I'm personally watching so you can watch it too. Now, quick message to the real audience before we dive deeper. I'm running a campaign to eliminate copycat channels that recycle original work and flood the platform with low-effort re-uploads. If you get value from what I do here, support the campaign in the simplest way possible. Subscribe to the channel and comment OG John AG. That comment matters more than you think because it tells the algorithm you prefer original work, and it tells me you're part of the core community. And because I want the real community close, I've also created a WhatsApp channel for daily updates. Short notes, fast alerts, and quick video drops that YouTube sometimes fails to deliver on time. The link is in the description. Join it so you don't miss the next key move. All right, jumping in. When silver breaks a level like $90, the market doesn't just celebrate. The entire pipeline gets stressed. Refiners, wholesalers, distributors, and mints all feel it. And when the pipeline feels it, behavior changes. Sometimes the change is loud. Sometimes it's subtle. But either way, you can see it if you stop staring at the chart and start watching what institutions and retailers do. This week, the conversation exploded around restrictions. Some of it is rumor, some of it is fact, and some of it is rumor that points toward a very real trend. So let's separate the pieces. First, retail buying limits. The story making the rounds is that a major retailer is limiting silver purchases. People heard limits and immediately jumped to, they're out of metal. Slow down. Limits don't automatically mean zero inventory. Limits often mean the store is protecting itself from being used as an arbitrage machine during fast rallies. Here's how it works. When silver moves $5 or $10 quickly, certain retail channels become a cheap source of metal relative to the new spot price, especially if their pricing updates lag the market. That attracts buyers who treat the store like a faucet. They buy big, they buy fast, and they repeat. So the retailer reacts with guardrails. 1 unit per transaction, 1 tube per purchase, 1 sleeve per checkout. Not forever, not always strict, but enough to slow the drain. And that guardrail matters because it tells you demand behavior is intense. Calm markets don't require guardrails. Calm markets don't get mobbed. Guardrails go up when the flow is getting too hot. Second, the delayed Silver Eagle release. This is the bigger signal because flagship products aren't delayed casually. The official explanation you'll hear is volatility, pricing, schedule, or operational timing. Those can all be true, but here's the deeper point. Volatility itself can be a symptom. If silver is truly plentiful and the pipeline is smooth, volatility tends to fade. If volatility persists, it often means the market is struggling to balance the real thing. So ask a better question. Is the delay about timing or about sourcing and cost control in a market that won't settle down? Because when a mint delays, it can be trying to avoid getting trapped selling product into a rapidly changing price environment. Nobody wants to be the easiest place to buy metal below the new reality. Third, the futures exchange and margins. An exchange announced it will adjust how margin requirements are set for gold, silver, platinum, and palladium after sharp swings and heightened volatility. Most people hear margin changes and assume bearish. Sometimes margin hikes do cool speculation. But margin changes can also mean something else. The exchange is adapting to a new volatility regime and trying to reduce default risk. And that's not always a negative for price. In fact, it can be a sign the market is graduating into a more serious phase where risk controls have to catch up to reality. Now here's where the story gets spicy. These three threads are not random. When you see retail guardrails, production delays, and exchange rule adjustments clustering together, it's often because the system is trying to manage pressure coming from multiple directions at once. And that pressure shows up in another place too, regional pricing spreads. One of the fastest ways to understand physical stress is to compare prices across regions. When silver trades meaningfully higher in one market than another, it suggests friction, demand, logistics, currency, taxes, local policy, or outright scarcity. Spreads can open for normal reasons, But when spreads widen and persist, it becomes a thermometer for stress. And you've likely noticed people discussing a widening gap between silver pricing in China and the US. The exact numbers move, the spread changes, and the reasons can be multiple. But the important part is this: fragmentation increases when markets are stressed. Silver stops behaving like a uniform commodity and starts behaving like a fragmented asset with regional premiums and bottlenecks. That fragmentation is where surprises come from. Now, I want to make something clear. You don't need to accept every rumor as truth. You also shouldn't dismiss every rumor as nonsense. The right approach is to watch behavior. Rumors are noisy. Behavior is the signal. So what behavior would matter most? Delays that extend, limits that tighten, products that quietly vanish from listings, delivery windows that stretch, premiums that jump while spot is calm. Those are the tells. And I want you to think about this. If everything was normal, would we see these small coincidences stacking up at the same time? Or would we see business as usual? Let me ask you directly. Do you think this is routine volatility management? Or do you think the physical market is being squeezed? Drop your answer in the comments. Now, quick creative detour because I promised I'd do it. If you enjoy silver-related success stories and you want to see how real people made smart moves and built real results, there's a link in the description to another channel focused on those stories. Go subscribe over there too, because seeing what worked for others can sharpen your own plan. All right, back to the main track. The reason this moment matters is not just the price level, it's the attention. When big box retailers, mints, and exchanges become part of the same conversation, silver stops being a niche topic and starts becoming mainstream again. People who never cared start asking questions. People who never owned start buying. And that's how the next phase builds, through awareness, not just through charts. And awareness creates a feedback loop. More attention brings more participation. More participation tightens supply. Tight supply increases volatility. Volatility triggers rule changes. Rule changes create more headlines. More headlines bring more attention. That loop is how quiet markets become loud markets. Now let's talk about the exchange angle again, because it's easy to misunderstand. Raising margins on big contracts can push out weak hands, yes, but exchanges also like volume. If they push out retail from the large contract, they often create smaller, more accessible products, so more people can participate with less risk. That's like turning one big door into many smaller doors. And when you create smaller doors, you invite the masses. The masses don't need huge leverage to matter. 1 million small buyers can do more long-term pressure than a few big gamblers. That's why broad participation is often bullish for metals over time. So don't just hear margin and panic. Ask, is the system tightening because it expects the ride to continue? Now, here's the cliffhanger you should hold in your mind. If silver can run above $90 and already trigger delays and limits, what happens if the next leg goes higher? What happens if the next move forces premiums to disconnect from spot? What happens if the temporary delay becomes an extended delay? Because at that point, the story changes. It stops being a trading story and becomes a confidence story. And confidence stories spread fast. This is why I keep telling you, watch the physical signs. The paper price can move in seconds. The physical pipeline can't. When the pipeline tightens, it reveals itself through small policy shifts, soft restrictions, and quiet adjustments. Now, let's bring this back to something practical. If you are watching silver and you're trying to decide what matters most, focus on 3 buckets. Bucket 1, availability signals. Are products available? Are release dates stable? Are wholesalers quoting normal delivery? Are retailers changing purchase policies? Bucket 2, pricing signals. Are premiums rising? Are spreads widening? Are regional prices diverging? Is the retail market acting differently from the futures market? Bucket 3, rule signals. Are exchanges changing margin models? Are contract specifications being adjusted? Are risk controls being tightened? When you see all 3 buckets flashing at once, you don't ignore it. You pay attention. And now, I'm going to politely complain for a second because it affects how often I can do deep coverage like this. My analytics show a lot of people watch these videos but haven't subscribed. If you're still here, it means you're getting value. Help me keep doing this. Subscribe now. And again, comment OG John AG if you support the campaign against copycats. Simple, fast, and it makes a real difference. Also, don't forget to join the WhatsApp channel for daily updates. I'll keep it short and useful, not spammy. The goal is speed and clarity. All right, we're in the final stretch, and I want to push one more idea that helps you understand metals markets in general. Gold and silver don't always trade like typical commodities. Gold is mostly a stock and flow asset. Nearly all gold ever mined still exists. That means price can be driven heavily by conviction flows, central banks, ETFs, institutional reallocations. Silver is more complicated because it's monetary and industrial. It gets consumed. It gets embedded in products. It can be harder to pull back into the market quickly. That's why silver can look boring for long periods and then suddenly turn explosive. And when it turns explosive, weak links show up first. Delays, limits, volatility, and fragmentation. Now, I'm not telling you to panic. I'm not telling you to do anything reckless. I'm telling you to watch signals like an adult. Markets reward awareness, not emotion. And I want to hear from you. At what point do you think physical availability becomes the headline? Is it a delayed release, a sudden premium spike, a longer delivery window, or something else? Tell me in the comments. And one more request, because I want this community to be useful, not just loud. If you've had success, any success, in building your finances, investing, business, savings, discipline, anything, share one sentence in the comments about what worked for you. Your story can raise someone else's standards and help them believe it's possible. So here's the bottom line. Silver breaking $90 is not just a number. It's an event that stresses the pipeline. Retail limits signal demand intensity. A delayed coin release signals the physical side is navigating a difficult price environment. Exchange margin changes signal the paper side is adapting to volatility. When those signals cluster, pay attention. If you want the fastest daily updates, join the WhatsApp channel from the description. If you want to support original content and help eliminate copycats, subscribe and comment OG John AG. And if you want me to keep covering silver like this, delays, spreads, premiums, rule changes, tell me, because I build these videos based on what you care about. Now, last question. Do you think this is a temporary storm or the early stage of something bigger in the physical market? Drop your answer below, hit subscribe, and I'll see you in the next one. Now let me do what most coverage won't do. Break this down into rumor, reality, and why the rumor still matters. The rumor is always dramatic. Sales suspended, no more coins, no metal left. The reality is usually more boring. Policies shift, release dates slide, and inventory is routed differently. But the reason the rumor matters is that it points your attention to a pressure point. If the market was loose and comfortable, the same rumor wouldn't keep resurfacing across multiple places at the same time. Think about it like this. In a calm environment, retailers want you buying more, mints want smooth releases, and exchanges want maximum participation with minimal rule changes. So when all three start adjusting behavior, it's not proof of collapse, but it is proof of stress. And stress is where the next move is born. I also keep seeing a viewer question, John, if silver is tight, why do I still see product available sometimes? Because tight markets don't mean empty shelves every second. Tight markets mean timing becomes everything. Inventory appears, then vanishes. Premiums jump, then pause. Delivery windows stretch, then compress. It's like traffic. Cars can still move while the road is clearly jammed. Second question, do margin changes kill rallies? Not automatically. Sometimes they create a shakeout that resets the market for the next push. If the market is healthy, it absorbs the rule change and keeps climbing. If the market is fragile, it cracks. So the margin change becomes a test, not a verdict. Now, what I'm watching next are three simple tells. 1. Do retail premiums stay elevated even if spot cools? That's a classic sign physical demand is leading paper price. 2. Do release timelines get revised again, or do they stabilize? One delay can be procedural. Repeat delays start to look structural. 3. Do we see broader micro limits spread? One per transaction rules, quantity caps, and quiet listing removals. That's the early warning system the public feels before analysts explain it. And here's the cliffhanger to hold on to. The next phase won't be announced. It will be felt in delivery windows, premiums, and how fast inventory disappears after restocks. If you want the fastest signal without the noise, join the WhatsApp channel in the description. And if you want to support original work while we push back on copycats, subscribe and comment OG John AG. One more thing before we close. A pullback after a breakout doesn't automatically cancel the story. Pullbacks can be how markets reload. The key is whether a dip brings relief to the physical side. If spot drops but premiums refuse to, that's a tell. If spot drops but availability doesn't improve, that's a tell. And if spot drops while limits remain in place, that's a tell. Also, if you've had any real success in your financial life, investing, business, saving, discipline, share one short line in the comments. Your win might be the spark someone else needs today. Tell me what you think happens next. Steady climb, sharp dip, or sudden supply shock.